Hello everyone, welcome back to the channel. So let's just get on to our next chapter, that is chapter number 6. The name of the chapter is Keynesian System Part 2, Money, Interest and Income. So in this very chapter we'll be talking about determination of rate of interest. So let's just get started, but just a 1 minute disclaimer that I am really assuming that you people already know what the entire 5 chapter is all about. Step number 1, 2, 3, 4, 5. We ought to have a complete hold over everything that we have studied up till now in order to understand this very chapter, because there is a lot of asymmetry information here. It's quite unusual experience to teach online because economics is a subject where there has to be a lot of interaction, but again it's not possible. So I just am assuming that we know what there are the things up till chapter 5. So as it's gonna be really convincing, easy on my part to assume this way, so that I am not supposed to just keep on dragging this video unnecessarily, just keep on repeating myself. So yes, I'll be really very precise in my explanation because a lot of explanation has already been done. So let's just get started. Enough of lecture. All right, so this chapter explains that role of money and the interest rate in the Keynesian system and construct a model that shows how interest rate and income are jointly determined. Forget about this. Right now we'll be just thinking about what exactly is the rate of interest. No talking about relationship between interest and income, nothing. Just keeping things simple. Let's put things into perspective. What exactly is the money supply, money demand, rate of interest in the Keynesian system? Alright. Fundamental to Keynes' theory of money was the view that money affects income via the interest rate. What exactly does this mean? We're going to be talking about this in a very detailed manner, but not now. This is not needed now. What's needed is just to understand how we're going to determine the rate of interest. Let's determine the rate of interest first, then we'll talk about all the income relation and all. Alright. So, what is investment demand? Quite obvious, investment demand is demand for investment and it depends on interest rate. As classical have also stated this very thing, Keynes also stated this thing that yes, investment demand is something that is inversely related to rate of interest, and why so we already know. No more explanation now. Alright, so if somebody is directly watching this very video, then I'm sure they're gonna not like it, but then this is how it is. We really can't just keep on lengthening the video by unnecessary explanation. We know why investment demand is inversely related to rate of interest. We have dedicated a complete video on this very topic. Alright, so this is directly how we're gonna be deriving the investment demand curve. Higher the rate of interest, lower shall be the investment. Lower the rate of interest, higher shall be the investment. Quite simple. Alright, and then we're gonna be showcasing this very investment demand into our aggregate expenditure income model. So if investment goes up, aggregate demand curve shifts upwards and income goes up. If investment goes down, aggregate demand curves shift downwards and income falls. Equilibrium income falls. We already know what exactly all these things are. No more further explanation here. Alright, now we are on to the main topic of this chapter and we'll proceed quite smoothly, quite in a very patient way from this topic onwards. Up till now it was just the revision sort of thing. Alright, the Keynesian theory of the interest rate. So Keynes believed that quantity of money played a key role in determination in the rate of interest. Please memorize this thing by heart. Quantity of money plays a key role, a very important role in determination of rate of interest. Now let's just pause a bit and contrast it with the classical version. What does classical economists say? They says that classical economists say that quantity of money determines what? It determines price level in the economy. Higher the quantity of money, high shall be the price level, and so high shall be the nominal income. But in case of Keynesian, quantity of money is definitely not impacting prices. Rather, it is playing a very important role in determination of rate of interest. Alright, and what plays an important role in the rate of interest determination in the case of classical economics? Quantity of money? No. the supply and demand of loanable funds. So these two are the main differences that we have understood between the Keynes and the classicals by reading the first line of Keynes itself. So yes, Keynes believe quantity of money determines rate of interest, alright, and we're gonna be seeing how. But let's just undertake certain simplified assumptions here. So Keynes assumed that there are just two ways to spend money, either money or to buy that money, to use that money to buy bonds. So money means money and bonds mean bonds, but we will be seeing what bonds are because we are studying economics as a subject, so generic knowledge is not enough. So Keynes assumed that all financial assets can be divided into two groups, money and non-money. So this is a drawback here because we know that we got a lot of other classifications also, but yes, Keynes system, money, non-money. Non-money assets mean bonds, and again money is highly liquid. It means like we have money, we can go to store and we can buy anything we need. Bonds are comparatively less liquid. So for example, if we have a bond and we go to market and we ask for what? We ask for, let's say, laptop with chocolates, and they're not gonna give us these commodities because they are not bound to accept bonds. So bonds are less liquid, and as such, what exactly is the liquidity? It is the property by which the easiness with which an asset can be converted into a currency. So for example, gold is there, which is highly liquid. If today we have gold and we go to a store, they're going to immediately give us the money and buy that gold. So we can immediately convert the gold into a currency format. But if we have building and we just want to convert into a currency, it at least going to take a year or 6 months at least. But so it's not liquid. All right. Now what exactly is a liquidity preference? So definitely preference for liquidity is liquidity preference, and liquidity is what? Liquidity is money. So Keynes termed his demand for the money asset as liquidity preference. So it's like we want to keep money into liquid form, and that is our liquidity preference. Alright, now we're gonna be undertaking one more assumption, that money supply. So definitely money, quantity of money determines the rate of interest. Quantity of money here means the money supply and money demand. But what exactly is the money supply? So we know there are 4 components of money supply into the economy: M1 component, M2, M3, M4. What is M1? So we all have studied economics from Runal sir, so we know what these components are. M1 is definitely a currency held by people, and CASA, that is current account, saving account. M2, we don't really need to understand M2, but again, because we are talking about this exam in a very holistic manner, so it's good to have a broad understanding. What exactly is M2? This should be at tips of our finger. It should be quickly coming into our mind that yes, M2 is this. So what is M2? M2 is M1 plus deposits, saving deposits with the post office. Then what is M3? M3 is M1 plus term deposits also, and M3 is broad money, because 3 is like B, so M3 becomes broad money. Alright, what is M4? M4 is again M3 plus all the deposits of the public, of the post office, excluding national saving certificates. So these things should also be clear what exactly these components are. So definitely from M1 to M2, M3, M4, the liquidity keeps on decreasing, but the money base keeps on increasing. So liquidity decreasing, money base increasing, this is how it is. So M1 is the most liquid money we can say. So as per Keynesian economics, money supply means just M1, that is currency held with the public plus CASA, current account, saving account, that's it. Alright, then what exactly is bonds then? Bonds are perpetuities. What is perpetuity? Perpetuity is something which doesn't have any end, which just has no end. So bonds, we are assuming they are never paid back. The principal amount is never paid back. All bonds yield is the interest that we are getting onto it. That's it. No repayment of principal over it. That's why bonds are perpetuities. So we got 2 assumptions here. Money supply is M1 component, bonds are perpetuities. Alright. Now Keynes stated that entire wealth can be held either in the form of bond or in the form of money. Quite simple. This again is simple, the highlighted portion, that if person is satisfied with its money holding, that by default he or she would be satisfied with the bond holding also. So equilibrium in one market means equilibrium in other market. If person is happy with the quantity of money she is having, it means she is happy with the bond holding also. But if she is thinking that the money holding is less, it means she is having excess of bond, so she is not satisfied with either case. So satisfaction in one market means satisfaction in other. This is what it means. So let's just read the highlighted portion now. In terms of equilibrium position, this means that a person who is satisfied with the level of money holding relative to the total wealth is by definition satisfied with the bond holdings also. Quite simple. Further, equilibrium in one market implies equilibrium with the other, as I have already explained. Now equilibrium, determination of interest rate. Determination of equilibrium interest rate. Again, money supply exogenously fixed by the central government has no relation with the rate of interest. Alright, money demand inversely related. Why exactly is it inversely related? We'll see when we talk about the individual components of the money demand. But let's just proceed as per this very book, and here we have already seen the determination. If money demand is downward sloping, money supply is quite inelastic, then this intersection gonna determine the equilibrium level of rate of interest, and that turns out to be R0, and this is it. Now let's just talk about the demand for the money. What are the components of the money demand? We'll talk about two components only, that is transaction demand and precautionary demand, because speculative demand is something that I would say is understanding about which is quite important for us to understand many other concepts also. So we'll talk about speculative demand in our next video, because I'm little short of time right now. So we'll end with the precautionary demand. Okay, transaction demand is what? So transaction means what? Transaction means buying goods and services. So individuals hold money to be used to carry out transactions. Alright, and higher our level of income, more will be into buying goods and services, more will be our volume of transactions. So in a way we can state that transaction demand of money is assumed to depend positively on income. You can have other ideas also, but right now we just have to simplify this model, and this is the assumption, and either way it's true. Broadly at a macro level it's true. Slight deviations are always there, but broadly it's true. So yeah, nothing wrong or unusual in this assumption. So transaction demand for money is assumed to depend positively on income. That means higher the income, higher shall be the transaction demand. This is what it is. Further, but again, a slight component is again there, but Keynes as such ignored this thing. And what exactly is this thing? So it says that if suppose the interest rate is high, so we know money asset yields no return. Money lying idle in our cupboard, it yields no income, no rate of interest. But definitely if we are to spend it into buying bond, it's gonna give us interest rate, and that is our income. So if interest rate is high, it means people gonna be sort of into incentives to economize their transaction balance. They would be sort of into the pressure to reduce their transaction balance so as to gain the interest rate. So this is what it is. If higher is the rate of interest, we might come across a scenario where the transaction demand is low, that people are gonna economize on the transaction balance. But Keynes ignored this very aspect. So yeah, just for the sake of explanation I have explained. But for our very model, all we have to keep in mind is that transaction demand is simply demand for undertaking transaction, and it is positively related to income. Alright. Further, second is the precautionary demand. So precaution means precautions, like precaution means precautions. To meet any unexpected expenditure, people can fall ill, any bad thing can happen, so we just have to have some sort of money with us. We can't just end up depositing our entire amount into the bank account. We have to keep a certain portion at our home with us in order to meet these unforeseen circumstances. So this is what precautionary demand is. But again, it is also positively related to the income level. If income level is high, he'll be more cautious. He'll be like, this can also happen, that can also happen. So he'll be willing to hold more and more money as a precautionary balance. So again, this is also positively related with the level of income. And again, people can economize onto precautionary balance also if they think that they are losing a big amount by not buying bonds in by not buying bonds and by losing the rate of interest that they would otherwise have gotten. So but we just have to ignore this very component, the economizing part we have to ignore. Just for the sake of explanation, I have explained largely the relation has turned out to be that both precautionary demand and the transaction demand, they are positively related to the level of income. So if they are positively related to level of income, so we can club them into one only, and this is what the author has done. So subsuming these two components into one. So yeah, we have talked about what exactly the money supply is, what is the bond, what is the role of quantity of money in the Keynesian model, what is precautionary demand, what is not speculative demand, what is transaction demand, and finally we just had a sneak peek into how is interest rate determined. But we'll of course go into detail of this, so do watch this video. And if you're listening this, you must have already been watching, but the point is, do read Froyen. After watching it, please read Froyen so that everything gets clear. Okay, UPSC frames question to confuse us, so please read the book on your own also. That's it. It's just a supplementary to the reading on your own things. Okay, so this is it, friends. Thank you so much for watching. Goodbye. In our next lecture we'll talk about the speculative demand, and it's a long chapter. Most probably we're gonna be taking 3 days to finish it off. All right, goodbye.